Hello, and welcome to the weekly economic brief. My name is Dr. Lindsay Piegza, Chief Economist at Stifel. Last week, all eyes shifted to the July employment report as the latest metric of labor market conditions and a potential directive of the Fed's next policy move. Non-farm payrolls rose by 142,000 in August, falling short of the 165,000 gain expected, albeit still the largest increase in 3 months. The 3 month average, meanwhile, declined from 141,000 to 116,000. In the details, goods producing payrolls increased by 10,000, while services payrolls rose by 108,000, double the gain the month prior. Education and health payrolls led the gain, rising 47,000, down slightly, however, from the increase in July. Leisure and hospitality payrolls also rose, gaining 46,000. Construction payrolls increased 34, and government payrolls climbed 24,000. On the weaker side, information payrolls decreased 7,000, retail trade payrolls declined 11,000, and manufacturing payrolls dropped 24,000, the largest decline since October. Meanwhile, household employment rose by 168,000 in August, following a 67,000 increase in July. However, with a smaller 120,000 increase in the labor force, the unemployment rate ticked down from 4.3 to 4.2%, a 2 month low, with the labor force participation rate holding steady then at 62.7% for the second consecutive month. And finally, average hourly earnings rose zero point 0.4 in August, a tenth of a percentage point more than expected and double the increase in July. Year over year, wages rose 3.8%, up from a 3.6% gain in July and the fastest pace in 2 months. Along with the latest payroll data, an updated release from the JOLT survey, or the Job Openings and Labor Turnover Survey, showed the total number of job openings dropped to 7.7 million in July, the lowest level since January of 2021, with the ratio of job openings to unemployed people falling to 1.1, now below the pre-pandemic average of 1.2. Aside from fears of a further slowdown in the labor market specifically, the latest read on the ISM underscored concerns of mounting weakness more broadly in the U.S. economy. In the latest read, U.S. factory activity remained in contractionary territory at a reading of 47.2 in August. Despite the monthly uptick from a reading of 46.8 in July, the August read marks the fifth consecutive month in contractionary territory, or a reading below 50. In the details of the report, supplier deliveries fell closer to break even at a reading of 50.5, a 2 month low. Production slipped just over 1 point to 44.8, and new orders fell from 47.4 to a reading of 44.6. On the stronger side, inventories climbed to just over a reading of 50, while employment increased by over 2.5 points to a reading of 46 in August, a 2 month high, albeit still marking the third consecutive reading below 50. Backlog of orders also gained roughly 2 points in August, while prices paid rose just over 1 point to a 3 month high, despite easing energy prices. In fact, speaking of energy costs, oil prices dropped below $70 a barrel earlier last week, for the first time since the beginning of January, wiping out the gains for the year. Analysts suggest ample inventories at the end of the summer driving season also put downward pressure on pump prices, currently at a 7 month low. According to AAA, the average national gasoline price is at $3.32 a gallon, the lowest since February. Additionally, the latest Beige Book also raised some alarm, reporting stagnant and declining activity growth in the U.S. According to the latest report, economic activity grew in 3 districts, while 9 districts reported flat or declining activity, and this is up from a reported 5 districts in recent weeks. Of course, not all the data proved disappointing last week. Not all the data pointed in the direction of a weakening economy. The ISM Services Index, for example, unexpectedly ticked up minimally from a reading of 51.4 to 51.5 in August, a 3 month high. According to the median forecast, the index was expected to remain unchanged for a second consecutive month. In the details, prices paid rose to a 3 month high. New orders ticked up more than half a point, and the change in inventories pushed up back over a reading of 50. Also, supplier deliveries rose 2 points to a 2 month high. On the other hand, business activity did fall 1.2 points to a 2 month low. Employment declined to a reading of 50.2, now hovering just above break even, and the backlog of orders dropped to a reading of 43.7 in August. Or even on the labor market front, not all data has weakened or proven disappointing. Jobless claims, for example, fell 5,000 in the latest report to 227,000, the second consecutive weekly decline, pulling down the 4-week average from 232 to 230,000. Continuing claims, or those claiming ongoing unemployment, also dropped, falling from 1.86 million to 1.84 million. That being said, conditions are less tight, both broadly and in the U.S. labor market, at least relative to where they were at the start of the year. Still, the expected slowdown in demand and the overall impact on the U.S. labor market remains modest, again, suggesting more of a normalization of labor market conditions, as Powell described it, as opposed to outright weakness. Of course, relativity aside, a growing concern of impending weakness as a result of softer economic data has compounded downward pressure on yields across the curve as investors ramp up bets for a more aggressive response from the Federal Reserve. The spread between the 10-year and 2-year Treasury yields, in fact, normalized last week for the second time in over 2 years, with the curve temporarily uninverting on Wednesday after a similar temporary normalization last month. Of course, acknowledging cooling conditions last month at Jackson Hole, Chair Powell noted the committee's attention has adjusted from inflation to both improved inflation and slowing employment at this point, warranting now an adjustment in policy. Of course, a waning but still positive pace versus outright weakness in hiring will seemingly determine the size and extent of rate cuts in the near term. An economy simply normalizing poses neither a sense of immediacy nor the need for an expedited timetable in terms of policy adjustments, presumably resulting instead in a slow and tempered pace of policy action, potentially falling well short of market expectations. In fact, speaking last week in the aftermath of the latest employment report, Fed Governor Christopher Waller said he is open-minded regarding a larger rate cut at the September 18th meeting, but noted that such a more aggressive policy response would need to be warranted by the data, presumably by a material downgrade in either inflation or the employment picture. Somewhat throwing cold water then on the prospect of a stronger policy response, meaning a larger sized rate cut next week, despite the confluence of disappointing data and reports. Honing in on Waller's comments, investors dialed back the probability of a 50 basis point cut from near 60% before his remarks to just 29% as of the close on Friday afternoon. Although the market is still anticipating a cut at every remaining meeting this year, with a total of 110 basis points of rate reductions by year end. Now, as the Fed ends its 13th month-long pause and deliberation on the sidelines, presumably gearing up for a near-term rate reduction at the September meeting, other central banks are already moving further down a pathway of policy easing. The Bank of Canada, for example, cut rates 25 basis points last week to 4.25, the third consecutive rate cut, with presumably more to come. Following the announced cut, Governor Macklem said it's reasonable to expect further cuts. The latest from the BOC follows similar action from the ECB and BOE. The ECB cut rates 25 basis points on June 6th, with the deposit rate declining from 4% to 3.75. The BOE, meanwhile, first initiated rate cuts August 1st, reducing policy 25 basis points to 5%. This week, the economic calendar begins today with a look at wholesale inventories and July consumer credit. Tomorrow, we'll look at the NFIB Small Business Optimism Index for August, ahead of mortgage applications on Wednesday, along with a key report of the week, August CPI, followed by the PPI on Thursday. Following hotter than expected readings in the first quarter, the CPI cooled somewhat in April, with further improvement in May, June, and July. Despite Fed officials already indicating a rate cut is near, all eyes will still be looking towards this week's report as a further indication as to the size of the policy response needed or warranted, as the committee continues to strive for price stability. The August CPI is expected to rise 0.2 and 2.6% over the past 12 months, potentially declining from the 2.9% annual gain in July. Meanwhile, the PPI is also expected to rise 0.2 in August and 1.8% year over year, potentially marking a more sizable decline from the 2.2% annual increase in July. Excluding food and energy costs, the core CPI is expected to increase 0.2 and 3.2% year over year, potentially matching the gain last month, while the core PPI is expected to rise 0.2 and 2.5% on an annual basis, potentially rising from a 2.4% pace reported in July. Also on Thursday, initial jobless claims will be reported, followed by import and export price indices on Friday, and the preliminary September Consumer Confidence Index from the University of Michigan. And finally, on the FedSpeak front, ahead of that highly anticipated September 18th rate decision, Fed officials will enter their usual FedSpeak blackout period for the week. And with that, I'd like to thank you for starting your week with Stifel.